Hello, everyone. Hope you've all had a good weekend. Today, I'm going to be looking at the products market and a quick video on gasoline specifically. I'll most likely do a middle distillate diesel one at a later stage, as there's a lot going on in that market too. There is some overlap, and I will be touching on that, but the main focus here will be on the gasoline market. So let's dive right in. What's shaking in the products market? So just having a look at the price charts here. On the top, we just have the flat price chart, and at the bottom we have the front spread. At the top's the continuous contract, and we can see throughout the month of March things sold off pretty aggressively. We saw the gasoline cracks go negative, and kind of through the month of April, things have steadily flatlined. Then on the bottom, we see the front spread go from beginning of March, the market was in backwardation, and then we saw the sell off into fairly steep contango for an RBOB market through to the end of March. And then kind of at the beginning of April, we see things pick up and turn back around and get a little bit more constructive there. We saw the front spread tightening due to imports from Europe into Pad 1 decreasing, along with refinery run cuts, resulting in the first inventory draw in Pad 1 that we've seen in the last couple of weeks. Having a look at some of the EIA balances, we have the total balances for gasoline stocks, as well as then next to that on the right hand side, the Pad 1 gasoline stock. We can see the last couple of weeks there's been aggressive builds, and the chart on the right hand side is just to kind of show the extent of how much Pad 1 contributed to these builds. Diving into the numbers a little bit for Pad 1 and why we saw those draws, you can see here Pad 1 week on week change, 180 a day less imports into Pad 1. This is for total product net imports, and that's made up of mainly motor gasoline, which is 140 a day less week on week, going from 368 down to 228, which is markedly less than the 4 week average that we saw of 373,000 barrels a day being imported into Pad 1. Having a look here at my outlook and view of the gasoline market, I wanted to circle back on a chart that I shared with you in my crude oil overview. Refinery runs that I'm forecasting for the balance of the 2020 year. I'm seeing 500,000 barrels a day more runs in May than what we saw in April. And then in terms of FCC units coming out of turnaround in May, we're seeing 300 a day more capacity in May versus April, specifically in Pad 3 in the US Gulf Coast. Looking at some of the headwinds for the gasoline market, gasoline imports in Mexico are set to fall in May, which is not boding well for the US Gulf Coast Pad 3 exports, where a lot of that goes to Mexico. Pemex said in its Q1 conference call that it expects imports of gasoline and diesel to decrease from May onwards for the rest of the year. And this was due to the high inventory levels due to the virus, as well as them starting up a couple of state-owned refineries. Increased FCC capacity coming online in May, which I referred to in the previous slide, 300 a day in May. So there's going to be a lot more capacity which refiners can use and which they could potentially use based on gasoline cracks. But as we'll see in the positives, there are some problems due to other product grades, specifically diesel and jet, that could hold refineries back from running full tilt. Looking at the positives for the gasoline market, some states coming out of lockdown, more implied demand. Seems like there's less fear in the air, and people are keen to get out and about. Diesel, jet, and other middle distillate margins have come under immense pressure over the last couple of weeks. Refiners may be hesitant to boost throughput too quickly, and this is kind of what I was referring to, where gasoline cracks have steadily improved over the last 2 weeks, but um, low sulfur diesel and jet have shown a lot of weakness, and we've seen them trading under the gasoline margins. So this could mean run cuts, specifically in certain parts of the world. I know there's a lot of pressure on European refiners trying to place diesel barrels. So we could see run cuts in the middle distillate area and improve margins on the gasoline side, incentivizing runs on the one side and run cuts on the other side. Gasoline cracks have shown a slight uptick over the last 2 weeks in Pad 1 and Pad 3 in the US. Freight rates are a big problem for the European refiners, and these rates have gone through the roof for the clean tankers, which carry the refined products. So these European refiners that usually export their barrels to Pad 1 in the US will be very cautious and unlikely to increase throughputs in the near term until freight cools off and they can find an open arb to place these barrels. Once this freight does come off, which we'll definitely be keeping an eye on, as well as the fixings out of Europe to Pad 1. There is a transit time, there is a loading time, there is dock space windows, etc. So there is a bit of a time lag on when these deals get booked and when the barrels would land in Pad 1. Takes us through to what I'm looking at. In terms of a trade structure, I like the call Condor gives some upside exposure, but limited, as I think we go higher from here. If we look at the price graph for the end contract, the orange box on the top graph is kind of the sweet spot for the core condor that I'm looking at. So I'm looking at a price breakout to the upside, but because of the headwinds, um, I think it will be limited. So I'll be looking at a 30 to 40 holding day period for an upside play in RBOB. This is supported if we look at structure. Um, Although flat prices kind of flatline through April, we see the front spread has shown some strength off the bottoms, indicating um, that it sees a tightening and an improvement, along with the gasoline cracks that have steadily improved over the last 2 weeks. Um, so I see a constructive picture, although I'm not flat out bullish. I see some price upside, so I'll be looking to play the Condor spread um, once kind of everyone gets into the office in New York and we potentially see some liquidity. So if those spreads are not too wide, I'll look to put something on there. And just looking at the kind of max loss, max return. So 205 points max loss, that's the amount that you'd pay for the spread for a 4 times upside max return. I mean, we wouldn't hold the position into expiry. So, we're looking at, between the 2 to 300 points of upside as the max sweet spot. And then to the downside, I wouldn't want to, lose much more than 100 points or 150 points. The spread will cost you about $860 per spread. So limited um, risk strategy for some decent upside, along with what I'm looking at in terms of fundamentals. And then later on, I will look at some diesel plays or kind of just diesel market, and that market I'm a lot more bearish. So if you're looking at kind of correlation trades or kind of hedged trades in different markets, um, that could be something that's interesting. So I'd have the upside exposure in gasoline and the downside exposure in the heating oil or diesel markets. So more to come on that later on the week. Hope you have a good start of the week. Chat soon.